Yeah, I hope you hear me well. The sound is fine. So, today is our second seminar. Yeah, and we're going to cover our second topic. Well, importantly. So, we'll talk about discounting and NPV. Yeah, last time we already covered discounting, like some very basic principles of discounting. Today, we'll just talk a bit more. Um, about different techniques in discounting, and then we'll see how we can apply them. Um, for this seminar, I asked you to finish reading chapter 2 in your textbooks, Principle of Corporate Finance. Yeah, which also is devoted to discounting and NPV topic. If you have any questions before we start, then just please raise your hand. Okay, if not, no, we'll then proceed. Yeah, and if there are some questions coming up, then just again, please raise your hand. I'll try to answer them. Okay, so today, we cover again, the first concept of finance, which is time value of money. Last time we stated, and justified why $1 today is more valuable, so worth more than $1 in the future. And we provided different reasons for that, including opportunity cost of capital, inflation, uncertainty. So so these are the reasons why we have this interest rate. And basically, this is the main so the existence of interest rate as the price of money is one of the key elements of financial market. So that is why we had to start with this. And again, these reasons why $1 today is more valuable will guide us through this universe of different discount rates and how to find the correct discount rate for your particular case when you evaluate the particular asset. Okay, so today, as I already mentioned, one of the applications of discounting involves evaluation of assets. Now, basically, the main application of discounting is evaluation of assets, both financial assets and non-financial assets. Last time, maybe you remember our final task, where we had one cash flow that asset generates in the future, and then we discounted this cash flow back to the present. In that way, calculating present value of this asset, and so which can be used as a market price. So which is the price we are ready to pay for this asset now, in order to get that cash flow in the future. So at that time, we worked with one cash flow. However, as you again may know, many assets offer a series of cash flows over time. Over time, not just one, and they may be uneven, even, or equal. So if then a financial asset, or any asset basically, if an asset offers us a series of equal cash flows, then we can just shorten our calculations of present value of this asset by using ordinary annuity formula. So again, this annuity formula works for equal cash flows over some determined period of time. Maybe a short period of time, longer period of time, but it should be some determined period of time in order to calculate it. So let's look at this formula. We calculate the present value of this asset for today, but please be careful. The assumption of this ordinary annuity formula, yeah, ordinary annuity, is that our first payment, this cash flow that is equal over time, yeah, that we receive every period, so takes place in 1 year, which means, yeah, we're considering the timeline, we receive this cash flow in 1 year. Yeah. So when we start receiving it in 1 year, we receive some number of cash flows. So the present value that will be calculated with this annuity formula is for 1 year back, yeah, for today. I mean, right now it sounds very easy and straightforward, because last time we also considered in discounting, yes, these assets that start paying in 1 year, so we discount this first cash flow as well. However, if, for example, you have a task that like a financial asset starts paying you in 1, 2, 3, 4, 5 years, yeah, so this first cash flow happens, like takes place in year 5, yeah, so this is our first cash flow. Let me erase this. And you need to calculate the present value for today. Yeah, first you calculate annuity, which gives you, again, which provides you the present value for 1 year back. Yeah? So for year 4, basically. And then you have to discount it back to today from year 4, not from year 5. Yeah. So when we just shift this same assumption around time, yeah, across time, it becomes less apparent, yeah, that we have discount these present values by less number of years. So just please be careful here. If you have an asset that starts paying you like at the same period as you want to calculate your present value for, then you have to use annuity due formula, annuity due, which is basically our ordinary annuity multiplied by 1 plus R. And this way we account for this one more cash flow. So like the shifts of cash flow from year 1 to year 0. So just please, yeah, pay your attention. Okay, so we, as the elements, yeah, of ordinary annuity here, we need to know this annuity payments, we need to know the discount rate, and again, discount rate have to be periodic discount rate. It doesn't have to be annual discount rate. If it should correspond to the cash flow you receive. If you know that you receive cash flow equal cash flow every 3 months, yeah, then your rate should be quarterly rate, yeah, so that the whole formula is consistent, and then you will take this number of quarters here, number of periods. So again, yeah, just don't forget, better to double check yourself if your formula is consistent. Okay, so this is for the present value of series of cash flows. We have this annuity factor over here. So you may find they're available over the internet, different financial tables, which, yeah, where like all the calculations of annuity factors are provided for a particular rate. I don't mind you using this table. However, I haven't seen it in practice that people use this table. So for you to be more prepared for your future career, I would recommend to get used to Excel or at least financial calculator. So that you don't need to learn these techniques twice. Yeah, better to start with Excel by skipping these financial tables. But it's up to you, yeah, how you find more convenient. Okay, the same thing, yeah, as present value of series of cash flows, we can calculate the future value of series of equal cash flows. So here you again can see ordinary annuity for future value, which is our cash flow. Here you have a bit transport formula. If you don't want to learn this formula, but you want to know how it was derived, to just understand this formula, again, in your textbook and or in some supplementary materials, you can easily find how from this geometric like average, basically, not geometric average, but geometric consequence, of payments, we can transform it to this shortcut formula. I won't elaborate on this now. Maybe you will cover it during your lecture. Here, we just have to practice this formula. Again, if you're more interested in this formula, you can find more materials on how it was derived, created. So this is for future value, again, for cash flow starting in 1 year. Okay, so any questions so far regarding annuities? So then question to you. What about these assets that provide series of equal cash flows over time, over some predetermined time? Can you name any examples of such assets where we can apply this annuity formula? Again, if you're ready, just please raise your hand. Any assets that will provide, not necessarily financial assets, any assets that can provide you some determined stream of equal cash flows over time. Aziza, please.
Maybe house mortgages.
Could you elaborate, please, how they provide us?
You have determined interest rate that you have pay every year, and determined period that in what period you should pay off your debt for house.
Yeah, exactly. So then for lender, that will be cash flows that he or she receives. So this predetermined cash flows. It's so it works. One of the best examples, as Aziza provided, is debt. So different debt obligations that we take. For example, if we consider bonds, right? Here, so what is the bond? We pay some particular price for this bond. So by buying this bond, we lend money to the issuer of this bond, to the borrower. So for example, we pay $100 for this bond today. Then bond provides us some particular mostly fixed, but not necessarily. I'm considering just a classic, simple example of bond, which provides us some particular interest every period that may be, again, quarterly, semi-annually, or annually. So of 5%, of 5%, which means that this is 5% of the face value of the bond. Here, let's consider that face value is equal to price, so $100. So we receive $5 every year, and then by the end of the maturity of the bond, we receive the face value of the bond back, this $100 that we paid, and final coupon payment. So we can just take all the coupon payments and calculate their present value as annuity, and then take this face value of $100 and calculate its present value. And then by summing it all up, yeah, we see how much. So we're gonna we can discount this cash flows by some opportunity cost of capital. So for example, we can invest this $100 not in a bond, but we can invest it in a coffee shop that will provide us, let's say, 7% a year. So we can discount it by some other rate to compare these two projects. Well, these two investments, for example. Yeah, it works very nice with projects, again, in which you assume that the cash flows will be equal. Yeah, in practice, for most projects, cash flows are unequal and it's hard to determine them. But for example, if you have some contract, you already have a consumer, and contract with some fixed payments over years, then why not? Okay, so let's then practice a bit with annuities. So at retirement, a client has two payment options: 20-year annuity at 50,000 euros per year, starting after 1 year. So again, this brief note, allows us to use ordinary annuity formula, not annuity due, or a lump sum, which means just total sum of 500,000 euros today. If the client's required rate of return on retirement fund investments is 6% per year, which plan has the highest, so the higher present value, and by how much? So which means which plan he should choose. Okay, I'll give you a couple of minutes. And please, if you're ready, just raise your hand. So here again, just just if you want to write in the chat, just please provide part of your calculations. Just to give a hint, for the former, or for the second, option, the present value is already given. We don't have to calculate it. We just have to calculate this present value of annuity in order to see which present value is higher. And then think about why. So where we can find the discount rate for this case. In this task, it is 6% per year, but if your parents, your client had such a choice, yeah, between two options, where would you advise him to, like, which rate would you advise him to choose? Again, if you're ready, just please raise your hand. Yeah, I see many of you are. So, yeah, I see many of you already in the chat. Well, so here, what we should do, we just have to apply the ordinary annuity formula for this first choice, first option. We just take our 50K euros payments over here. So as they're paid annually, we just take our annual interest rate as it is, 6%. Yes, and number of years 20. So we just directly apply the formula and we get 573,000 euros, 496, yeah, which is higher than our 500 euros. It is higher, so as we discount it, yeah, and we use compounded discounting, yeah. So it is not just higher than 500,000 euros, but it is higher than our investment of 500,000 euros in an asset that provides us 6% per year. Yeah, so why here we chose to divide by this discount rate? Because if we received, yeah, if the client received this money, 500K today, yeah, he had an opportunity to invest this money in some asset that provides 6% a year. Yeah, so that is why we discount our another option, yeah, by 6% in order to compare these two choices. So this is his opportunity cost of capital, yeah, because he gives up this money today, he loses this opportunity to invest, yeah, this money at 6% a year. Why does he do this? Because, yeah, the first option provides him higher return than the second one. Yeah, so this is why we chose this discount rate. Here it works as an opportunity cost of capital. We can take it from, I don't know, that may be anything. That may be just some very safe bonds, like government bonds that provide 6% a year. So it is, yeah, very close to reality. If this discount rate was higher, then maybe he would have invested in equity market. Maybe he has a grandson, yeah, who wants to open, I know, his like easy shop, and yeah, offers him like this average return of 6%. So it is any other investments that we could take. Yeah, we could buy this asset, invest in the asset if we have this money today. Okay, any questions? All right, so for now we considered question in the chat. For now we considered an asset that provides you series of cash flows over some finite period of time, here 20 year. However, we also have assets that can which cash flows can stretch indefinitely, basically. So these cash flows are perpetual. They will provide us cash flows forever. So in order to calculate a series of equal cash flows over perpetuity, that will be provided forever, we use this ordinary perpetuity formula again, and the assumption stays the same. So we divide our annuity payment directly by the interest rate. Question to you, again, what can be this magical asset that can provide us cash flows forever? So we can evaluate it with this perpetuity formula. Okay, so while you're thinking of examples of such assets, I will just answer the question in the chat. Do we calculate inflation? So here, if we consider this opportunity as so if we had 500,000 today, we would invest in government bonds that provide us 6% per year. So this yield on government bonds, return on government bonds, already includes inflation. So in general, yield on an asset is built as a risk-free rate, which incorporates inflation, and then some different premiums, based on the type of risk we take. We can have term premium, so premium for time. That is why 30-year bond provides us higher annual rate than 1-year bond, because over 30 years we face more uncertainty. So there can be credit premium, so the risk that the issuer, so borrower, will not pay us back. Then if we there may be liquidity premium, so if it's hard to sell this asset, to transfer it to cash back, and then some equity premiums. So inflation is already incorporated in here. Okay. So any assets that can provide us perpetual cash flows? Ilya, please.
As far as I remember, after the World War II, UK issued war bonds, and they obliged themselves to pay money, and it was a perpetuity, but they redeemed it 6 years ago.
So they basically purchased them back from the holders, from the bond holders. That may be, so this example basically shows us the universe of these perpetual bonds. So what perpetual bond is? Let's consider first classic, like this classic vanilla bond, so which has some maturity. Here it is 1, 2, 3, 4, 5 years. What does that mean? So the bond has some face value, so it's nominal value that we will receive. So this is face value, or fair value. So that we will receive upon maturity, when it's basically debt. So this is the amount of debt that borrower wants to take. So for example, we gave, by buying this bond for $100, so we lend to the issuer of the bond this $100. So we exchange, we give our $100 in order to get this bond, to get this promise. And then we receive coupon payments, so cash flows every period, every year, let's say over 5 years. And then by the end of 5 years, upon the maturity, we receive our final coupon plus this $100 back. So this is very standard, very conventional structure of a bond. If we consider perpetual bonds, so what we get if we buy perpetual bonds, we buy it for $100 today. So we buy this right to receive cash flows every year, some fixed cash flows, for example, 1% from this $100. Well, in general, less than one. So over here, so you see, as there's no maturity of this bond, we don't have this date. We do not receive this $100 back. So we receive only this interest. This is the difference. Why do we buy this bond? Well, to fix our income. Why not? We have some fixed cash flows, and then when we want to get this money back that we paid for this bond, we can just sell this bond in 10 years, like basically whenever we want, to another investor. So you just sell this promise, sell this right to receive these cash flows to another investor. To just see how these bonds work in practice, you can look at Russian debt market. So VTB Bank had some issues of perpetual bonds. So you can just check it and see how it works, what coupon it offers, what is the face value, so nominal value of these bonds. So here it is. This is just a right. Basically, in this way, it is not some debt that we're going to receive back. But it is we're buying the right to receive some fixed income over perpetuity. If we consider non-financial assets, there was an example in the chat. So real estate. When we buy real estate to let it and get rental payments, also we get let's say fixed payments over perpetuity, and then we just resell this property to another investor, to another buyer, and then this another buyer will receive cash flows by letting this property. So this is it. If we want to account for inflation here, so of course, for example, real estate, our rental payments are not fixed forever. They're fixed over some lease terms, or we can, in our lease agreement, say that every year rental payment will be adjusted for inflation. So then we can transform this formula and this growth at which we want our cash flows to grow. So if we know that our cash flows will grow with some particular rate every year, so 1 plus g, growth rate, then we just transform this formula. In denominator, we just subtract from our discount rate this growth rate. Of course, this growth rate shouldn't be higher than discount rate in order to be able to apply this formula. And here we consider very long-term growth rate. So not just some booming market with booming cash flows. No, we consider very long-term growth rate that for a company, or we consider a company should not exceed the growth rate of GDP. Otherwise, it means that the share of income of your company becomes higher and higher in total national income, in total GDP, which is over long run, not sustainable. So that is why this growth rate will be like trend GDP growth in general. So you see, I mentioned companies here, and this is again one of the main assets that we can evaluate with this perpetuity formula. So to understand how we evaluate, okay, easier to do this, how we evaluate companies with how we can apply perpetuity formula for companies. Let's consider two companies. Company A costs, so its price in the market is $100 million. While company B, its price is $1 trillion. So we have two companies. One is $100 million, one is $1 trillion. Why company B costs so much higher than company A? So where does this value come from? So this is the first, if you look at financial markets, you'll see price per share. So price of the whole company, this is price per share multiplied by the number of shares, as number of shares are quite stable over time. So there are some repurchases, there are some additional issues, but they're well known by the market. There's no secret there. So as this quantity of shares is quite obvious and stable, then to understand what's behind price per share, we need to understand what's behind price for the whole company. Since price per share is just the price of the part of the company. So what is the difference? Why for Apple company market is ready to pay $1 trillion, and for I don't know, any other like smaller company, like some startup, market is ready to pay $100 million? So again, just please raise your hand, so I don't need to read out loud your suggestions. So here in the chat, because of the prestige or amount of sales. So what is prestige? Evgenia, please. What do you mean by that?
I mean that many people know about Apple, know about Apple products, and they are ready to pay a lot of money for Apple products, because we all know that having iPhone is very fashionable now. And for example, if on the market we have Samsung or just other, I don't know, new phone with the same functions, for example, but with unknown from unknown company, we would rather buy iPhone, so we would rather buy Apple. So that's it.
So here you considered, if we just dig into details, you considered the consumer behavior in Russian market. If we look at figures, Samsung already sold more smartphones than Apple. But in general, why Apple still is more valuable? Because of its profits. So even if sales per phone, so items, will be lower than Samsung, its cost structure, its other services, like right now they're trying to put emphasis on services like different like game services, streaming, music, and movies. So in general, company is more valuable because it generates more cash, and that's it. And all these things like trust, prestige, and everything, it's good to have them, but you have to monetize them. Yeah, so you can be popular, but still you have to monetize. So to transform all these intangible assets like trust and so on to money. Yeah, if we talk about finance here. So yeah, the primary goal of a company is to provide value to shareholders. And what this value to shareholder is, it is the capital gain, so that the price of this company tomorrow will be higher than today, and dividend payments. So all this value for shareholders stems from how much money can company generate. Yeah, the higher cash flow company generates, the more valuable it is, and that's it. That's how we do this. So what cash flows we consider here? Yeah, here this $1 trillion represents not past cash flows, not cash flow for this year, but represent future cash flows. Yeah, so expectations of the market about the future of the company. That's why we see why Tesla company is so valuable right now. If we look at its financial statements, it doesn't generate much cash. Yeah, I mean, in just recent past, it generated only losses, no cash at all. But since investors believe that in the future it will, yeah, again, generate mega bucks, so these crazy cash flows, they are ready to pay for this today, because they believe that in the future it will be more valuable. Their shares will cost higher, again, because in the future the cash flows of these companies will be very impressive. So here the main problem in investing is that we talk about future. Yeah, so in order to apply then all these annuity formulas, discounting, perpetuity, yeah, so discounting in general, we need first to forecast these cash flows. And the way I forecast these cash flows and you forecast these cash flows, it may be very different. Yeah, so I will get one range, you will get another range, and who's right, who's wrong, yeah, only time can tell. So we will have to wait when our expectations, yeah, meet reality, basically. So first we need to forecast these cash flows, and okay, we can forecast them for 5 years ahead. Yeah, so at least we can look at historical data, then adjust. So we can forecast what's going to be the market growth rate in the future in 5 years. Yeah. Okay, let's assume we can quite accurately forecast for 10 years in the future. Yeah. So more or less, yeah, that this forecast of annual cash flow for each year, yeah, up to 10 years may be more or less precise. However, to forecast over, yeah, the prospects of Apple in 30 years, it's going to be absolutely pointless, because we will never we'll never get any hints, any idea what's going to be in 20, 30 years. So in this way, we're going to forecast for 10 years, yeah, this horizon of foreseeable future. And then what we're going to do, we will just take every cash flow and discount it back to today in order to calculate present value of the company. And then we can take this present value as the price of the company in the market. Yeah. So if there is an announcement that like Apple just gonna produce some absolutely innovative 7G smartphone, then we will adjust our expectations. So we believe that then future sales will be much higher, which means cash flows will be much higher, yeah, which will result in higher present value. So then the price of Apple in the market will go up. It is quite right, but not absolutely right. Yeah. So in this case, we assume that in 10 years, if we do not consider any cash flows after 10 years, we assume that in 10 years, Apple, yeah, will cease its existence. So it will just stop running, which is, we don't have any reasons to think that. So that is why we have somehow to account for all these cash flows from year 11 till some indefinite future, yeah, perpetuity. So in order to do that, we can just take this cash flow in year 11. Yeah, so we again forecast this cash flow in year 11. That may be like cash flow in year 10 plus some growth rates. So and then we believe that after 10 years, cash flows will be more or less equal, yeah, since this booming growth rates will go down, yeah, this company will become more established, mature, so the cash flows, this growth rate will not be so high. So that is why we assume that all cash flows after 10 years are more or less equal. So in order to do that, then to account for all this future cash flows, we can calculate the perpetuity of all these cash flows. So we just take this cash flow in year 11 and divide by our discount rate, which gives us the present value of all consecutive cash flows, yeah, from year 11 and so on, for year 10. So you remember, yeah, it is -1 year. So we're gonna have this present value over here, and then we just discount this present value to today and add it to the present values of all the cash flows over 10 years. And that's gonna be our total value of the company. So that's how we use perpetuity in evaluating companies. You see, so company is also an asset, yeah, and if we talk about some particular asset, this is the share, the stock of the company, or if you're a business owner, then the company in general, yeah, it is this asset that promises you cash flows over perpetuity. If you don't have some particular date when you're gonna sell, yeah, your company, or when you're gonna just stop your business, then yeah, we don't have any reasons to think that cash flows will not be over perpetuity. Again, even if you sell this company, then this other owner of the company will get these cash flows. So you see, it's yeah, one of these financial assets that we can apply this formula to. So real estate, companies, yeah, shares, well, equities, and some perpetual types of bonds. Any questions so far? Okay, so let's then a bit practice with this formula. So you would like to have enough money saved after your retirement such that you and your heirs, so your children, grandchildren, great-grandchildren, can receive $100,000 per year in perpetuity. How much would you need to have saved now, so at the time of your retirement, in order to achieve this goal? Yeah, assume the interest rate will be 12.5% a year, and the payments will start 1 year after the date of your retirement. Okay, so again, a couple of minutes and then we'll check. Maria, please. Go on.
Okay. We must find present value, and for it we must divide it 100,000 on 125 0.125, and then we receive 800,000 dollars.
Yeah, so here we just take our discount rate. Thank you. We take our discount rate of 12.5%, and then divide $100,000 by it, and receive $800,000. So we need to save $800,000 now, invest it in some fund that provides us 12.5% a year, and yeah, by doing that, we can receive, then can withdraw from this fund $100,000 over perpetuity. Yeah, so receive this cash flow. Okay, so now you, lucky, just inherited a trust that will pay you $100,000 per year in perpetuity. However, the first payment will not occur for exactly 4 more years. So assuming 8% annual interest rate, what is the value of this trust today? Yeah, so present value for today. I would recommend you again to draw a timeline here in order to understand when we're going to receive our first cash flow and for which date we have to calculate our present value. All right, Alisa, please. Yeah.
I guess that firstly we need to divide 100,000 by 8%. Then we have 125,000, yes, and then we need to divide this amount by 1 plus 8 to the third power, and we так, сейчас. 99 more. 9,992 and
992,000.
yes, and
Mhm.
290
And 290.
yes.
So yeah, you're right. Here the main issue is to understand that. Thank you, Alisa. The main issue is to understand that as our cash flows start from year 4, when you calculate perpetuity, so the first step, you get $1.25 million. That will be the present value of our perpetuity calculated for year 3. Yeah, and then you have to discount back to today. So from year 3, you will get $992,290,000. Any questions here? Yeah, so here you have to be very attentive on this, again, main assumption of ordinary annuity. Okay. If none, then let's move on. So last time we considered different types of compounding. So we mainly considered quarterly compounding. So I'll just remind you, that we can receive some stated annual interest of, for example, 5% from our investment, again, of hundreds. Some currency units, which means that we can receive, but we can receive this 5% annually with different types of compounding. So we can receive it annually, which means that we get this $5 by the end of the year. We can receive it semi-annually, which means that these $5 will be split in 2 tranches, $2.5, so the first half after 6 months, and then the second half after a year. So what is the difference here? Why do we need to account for compounding? Because if you have not annual compounding, so here semi-annual compounding, you can already after 6 months reinvest your interest at this periodic rate, so you don't need to wait for the year to reinvest your interest. And so if you split it in 4 tranches, which means you can reinvest again each tranche for the rest of the year. And in this way, we're gonna calculate our future values differently. So here, with annual compounding, our future value will be $100 multiplied by 1 plus 5% in the power of 1. And in case of semi-annual compounding, that will be $100 multiplied by 1 plus this periodic interest, so 2.5%. 2.5% in the power of number of periods. So we receive this 2.5% twice a year. So again, we do not receive 5% twice a year. We receive a half of this 5% twice a year. And we will see that our future value, so actually what we're going to get from the investment, will be a bit higher in this second case. So in order to see, not to calculate these future values each time, but to see what is our effective annual rate. So if our stated annual rate in each type of compounding is 5%, it doesn't change. How compounding will affect our, so what we're gonna get effectively, actually, in reality. So And this way we calculate effective annual rate, yeah, which is our periodic interest rate. So our 2.5% over here. Yeah, so rate divided by the number of periods in the power of number of periods minus 1. Yeah, here it was 2 periods. So here, yeah, we can apply it for quarterly, monthly, daily compounding. Also, we have continuous type of compounding, which means that you receive interest not on some particular date, yeah, but your effective annual rate is calculated in a way that if you received interest non-stop, yeah, so it is split in indefinite tranches over time. So we just take natural number and put it in the number in the power of discount rate multiplied by the number of periods. So if we invest with continuous compounding over 1 year, yeah, here number of periods will be 1. So let's then consider how we can calculate this effective annual rates. So calculate an effective annual rate if the stated annual rate is 16% and the number of payments during the year is 4. And also calculate if the stated rate is the same, 16%, but the number of payments is 12. Yeah. And also point C, a bank quotes a rate of 5.89% with an effective annual rate of 6.05%. So which type of compounding bank uses? Annual, quarterly, monthly, or monthly compounding? So here you already have stated rate, effective rate. You just need to solve this equation for the number of periods. Okay, so I'll give you some time to calculate, so to tackle all 3 points. And if you're ready, just please raise your hand. So in the first 2 points, to calculate effective annual rate, again, you just apply the formula, yeah, that we considered last time as well. So you just have to calculate first periodic interest rate. So how much interest we receive every quarter, yeah, and then put it in the number of periods. Dina, please. Yeah, go on.
Okay, so if the annual rate is 16 and we have to pay 4 times per year, we have to divide 16 by 4, and therefore we have 4%, and we will have to add this to 1. This will be like 1 and 4 out of 100, and we need the to write the amount of periods of payments, and it's -1. It will be nearly 17%, probably.
Yeah, and what about B? Have you calculated part B?
Okay, so we change 4 to 12, and we have so then we divide 16 to 12. It will be like 1 and 1/3, and
yeah, put it in the power of 12.
And it's something like 17% as well.
So here, yeah, it is always something like 17% in both cases, yeah. But here, yeah, we have to be more precise in order to see the difference, yeah. So here, these decimal points matter. So in the first case, you see that if we receive our interest 4 times a year, we receive by 1% more in total every year than with annual compounding. Yeah, with even more payments a year, we receive by 1.23% more than if we received it once a year. Okay, thank you. What about point C? Anyone is ready with point C then? What type of compounding bank uses? No? No one? So here, I would just explain then, yeah, you just need to build an equation basically and solve for a number of periods, yeah? So our 1 plus effective interest rate, 1 plus 6.05% is our stated interest rate divided by number of periods plus 1, yeah, in the power of number of periods. So we have here to solve for number of periods. However, as we have only 3 variants over here, we can just not struggle with solving for M, but just use trial and error method and see which of the variants provides us the closest result. Yeah, so here again, these decimals matter, so better not to round in order to see the difference. So it is in 4th decimal. We see that monthly compounding, yeah, provides us the closest result. So to our effective annual rate in the task. So we can then assume that bank uses monthly compounding. Any questions regarding this task, this point? Okay, so let's move on. Yeah, we considered different techniques of discounting, how to discount with series of cash flows over different periods of time. So where we can apply it, we have already mentioned different instruments that we can evaluate the discounting. However, yeah, so let's just consider it in a more systematic way. So as for main applications of discounting, we can consider evaluating financial instruments. So pension plans we covered in previous tasks. Yeah, bonds and equities were also considered as examples, and also evaluating projects. As we already looked at financial instruments, let's consider projects. So in order to understand if project is profitable or not, one of the very well-known, widely used indicator is net present value, which we're going to consider today. So let's skip this one. So what about net present value? Even from the name, yeah, you can assume what the formula is. So first we take present value, which going to be present value of our project. So present value of the cash flows that our project provides. So again, net present value is very well known for evaluating projects. Yeah, so we forecast our cash flows of the project, take the discount rate, which is some hurdle rate or opportunity cost of capital for the company that invests in this project. In this way, we calculate value is net of investments. Yeah, so of this initial outlay of money that we experience, so that we have at time zero. That is why we do not discount it. So this is these are our initial investments in the project. Yeah, in this way, the decision rule is quite straightforward. So if NPV is positive, which means that our cash flows, yeah, they cover our investments, and also not only our investments, but they cover opportunity cost of capital, which means that if we invested this money somewhere else at this rate, yeah, so we would also earn something. Yeah, so our cash flows from this project cover our investments and this lost opportunity of investing money somewhere else at this rate. Yeah, so if it is positive, then we invest. If not, yeah, then we leave the project. So do not consider it as an investment. Okay. Any questions so far? All right. So let's then consider an NPV of the project. Here you have a corporation considering an investment of 50 million in a capital project that will return after-tax cash flows of 16 million per year for the next 4 years, and then another 20 million in year 5. The required rate of return is 10%. So please calculate NPV of this project and tell if you invest in it or not. Again, couple of minutes. So here you can be creative with this discounting. Yeah, you can apply annuity formula for this first 4 years. Yeah, and then discount 20 million and add it together to find the total present value, where you can just use Excel, use financial calculators, up to you. Just a bit more time for you to complete, and then we'll check. No, NPV, it's not like just to invest or not. NPV shows us the profitability of the project. Yeah, so if NPV is $5 million, that means that we earned $5 million from it over, so on top of our investments and on top of this opportunity cost of capital. So I see many of you are ready, so let's check. Yeah, the NPV is 13.136 million euros. I saw like most of you completed it correctly. Yeah, but some problems, yeah, with some mistakes that I saw in the chat. So one of them was to account for 60 million only once. So if you receive only once in 4 years, well, you receive 4 times 16 million from year 1 to year 4. So don't forget about it. So overall, your present value will be 63.136. Okay, in this way, of course, we invest in this project since it provides us so this cash flows, yeah, they cover our initial investment, and they cover this again. So they are higher than if we invested this 50 million in somewhere, so in some other project with 10% rate of return. Yeah, so it means that if our cash flows, the present value of cash flows would be $50 million, yeah, so that our NPV is 0, it means that our cash flows, they cover exactly what we would have earned if we invested this 50 million at 10%. Which means that rate of return of our project over here, yeah, and it is called internal rate of return. So this return from our project each year, annual return, yeah, is 10%. So exactly the same as our required rate of return, 10%. Here, as NPV is positive, it means that it earns us more than this 10%, and that is why we invest in this project and not somewhere else. All right. Any more questions here? Okay, so that was final for today. As a home assignment, I would ask you to look at this task, yeah, and try to so look at where we should invest as a company. So this Westcott Smith should invest and why. Yeah, so just calculate the profitability of different options that are presented here. And then we will start our next session with considering this task. Okay, so yeah, any questions? All right, so if there are none, I will upload this presentation today, a bit later, and also upload your activity points today. So you will find all the needed info later today. Okay, well, so have a good rest of the day then, and see you next week. Same place, same time. Bye-bye. Goodbye.
Thank you. Goodbye.